All right. Good morning from Phil and Tony. We are on the road today and doing Filler Up Friday from a different locale than normal. But wanted to just welcome Mark Raccuia to the call today. He is with Vacasa. He's going to tell us what he does, and then he's going to help us know how to begin working with investors with this Working with Investors 101, the basics. All right. And then, Mark, I'm going to share, mark you as the host in 3, 2, 7, 1. All right. Take it away, Mark.
Cool. Thanks. I appreciate that. Just a quick introduction so that you know who the guy is that's talking to you. Again, my name's Mark Raccuia. I've been in real estate for 30 years this July. So I've been, I started my career as an auctioneer, traveling all around the United States when the economy was horrible back in 1993. Traveled in the back of a bus and sold homes and all types of real estate all throughout the United States off of the back of the bus in an auction center. From there, did all sorts of residential and commercial property sales, including development. Got my CCIM certificate probably, I think, 13 years ago. All that is a distinction in real estate that teaches you how to be a better evaluator of real estate deals. And that's what we're going to talk about here today, and why understanding real estate deals is so important to not only yourself as a real estate professional, but for your income generation for today and into the future, and how it'll set you apart from any other real estate broker. So with that being said, let's move on with the presentation. So one thing I would say is I've been coached by a lot of really great people, and the thing that I know helps people more than anything else is a little participation. So I would ask you to participate because I think the way, I know the way we all learn is through, reading and saying out loud and then practicing. So all of those things I'm going to try to get you to do. If you guys are up for that, let me know. Raise your hand.
Make them give you a shout out. There's 7 folks on here besides you.
Okay.
So let's all
Great.
participate.
Thank you very much. All right. So we're going to talk about real estate valuation basics and why they're so important to your career, and how it makes a huge difference, because so many people think that it's really not that important, and it makes a huge difference in your career. So who here has any idea why real estate analysis makes a huge difference? Anybody? Come on, one of you. I don't have names, so I can't call on you. But Phil, why don't you start? Just give me one reason why you think understanding that real estate makes a big difference in your career.
Understand how to
real estate analysis. Why understanding the numbers? Yeah.
You would know how to price property correctly.
Right. Well, that's for sure the biggest and most obvious. And on top of that, if you want to earn more money, the way to do it is to be an expert in analysis. And when I say expert, it means relative expert. I'm sure that all of you have heard people in your office say that they hate math. Well, I'm here to tell you, if you want to make money, you better learn to at least appreciate math and how that works. Because having the basic concepts down, like what we're going to talk about today, can help you get the listings on any kind of small investment property or any kind of cabin sale that there's a cash flow potential, and will put you far ahead of other people. What sometimes new real estate brokers struggle with is they may or may not own real estate. So when they're going to go talk to somebody who's sitting on $1 million piece of real estate or several $1 million pieces of real estate, and they don't own it, one of the things they do is they project their insecurity. And the way to get over that is to understand the mathematical concepts. And yes, while you may not own the real estate and know the pressure that creates on you, it'll certainly make you present far more superior and confident to your client. And at the end of the day, in a market like this, where there's a lot of real estate brokers and agents out there competing with you, just understanding the basics may really make a huge difference in your, in your presentation and in the likelihood of you getting either the listing or the sale. So that's probably one of the biggest things. And the other thing, and I know this is probably something none of you remember, but according to the Realtor Code of Ethics, and I'm going to have to look at it because I certainly couldn't remember it. For Article 11 says realtors aren't supposed to undertake or provide specialized professional services concerning type or property of service that is outside their field of competence. So if you have no competence in mathematical analysis, according to the Realtor Code of Ethics, you shouldn't even be taking on these projects. So really, you need to have some basic competence, and that's what we're going to teach you. I'll give you the slide later if you so choose to have it. They're really basic concepts, but things that'll make a difference. So before we go on, the question I have for you, what are the only two ways that we earn money as a real estate investor? Come on, you got to participate. I wish I had names here.
Close the deal.
There you go.
Close the deal.
No.
When you sell
Not
it,
as a real estate broker, as an investor. There's only two ways that you can earn money as a real estate investor.
ROI.
Well, income is one of them, correct?
and when you sell
And equity, correct?
Equity.
That's it. This isn't a hard concept, but it's one that you got to get. Income and equity. I'm going to make it real simple. Let's say you buy an income producing asset, whatever it is. If you make $500 a month and you do that for 30 years, over the mortgage, that is, so you pay all your expenses and $500 a month. At the end of those 30 years, you will own the real estate outright, and you've built a huge amount of equity, hopefully. And over those 30 years, you made $6,000 every single month, every single year, times 30 years. So you made $3,000, right? 500 times 12, right? 6,000 times 30, right? What is that?
180,
There you go, 180. Thank you. I'm still with my first cup of coffee. $180,000 in income in your pocket, as well as the equity you built up over that time. So if you bought that property for 150,000, by the time you sell it 30 years later, hopefully it's worth 350,000. So between those two, you make 350 on the sale of it plus the 180. That's the game. But how to take that and analyze it in day one for your client, that's what we're going to talk about. And I'm sorry that I cannot see my screen, but
If you hit the chat button, you can see everybody's name. We got
I
Chris,
see it now.
Shannon, Brian, Alyssa, April.
Got it. All right. And
Awesome.
Vernon, it looks like.
Vernon is in there. Yes, he's on the next screen for me. Yep.
All right. And you can all see this screen in front of me, my presentation. Okay. All right. The basic terms we're going to talk about today are just going to act as tools to help you understand, as well as a filter to move to the next level of analysis. I'm sure all of you, if you ever worked with an investor, they told me, go find me a good deal, right? And so that's a really subjective thing. These tools will give you the ability to take those subjective terms and give you some tools to ask him or her what it is that they mean by a good deal. Because what I think as a good deal may look different than what you do. So the terms we're going to go over today are gross rent multiplier. And I would like, just if you've heard of these things, just say yes or put your thumb up or something, so I know if this is stuff that you've heard of before. Have you heard of gross rent multiplier before? Okay. And then a 1% rule as a filter. Have you ever heard of that? Okay. Cap rate, I'm sure, because I've read it in the listings all over. You've heard that. We're going to talk about how that it should be used as an analyzation tool. Net income after financing, cash on cash return, and why treasury bills make a difference. A lot of people don't recognize why treasury bills and the impact that they have on real estate returns and on how some of your wealthy buyers look at what you're showing them. Okay, so we're going to start off first with just getting into the gross rent multiplier. Now, this is a very easy tool, and I'm sure once I explain it to you, if you haven't heard of it, it'll make sense. You can see the definition in front of you, but it's an easy calculation used to calculate the potential profitability of similar properties in the same market based on gross annual rental income. And to calculate that is a fairly simple thing. You take the total purchase price of the property and divide that by the annual rental income. So I put forth a couple examples to show you. Let's say you were able to find your client a property and all in to buy it, purchase price, closing costs, $300,000. And that property brings in income of $36,000 a year. You divide that income by that 300,000 and it comes up with a number of 8.33. Now, in the same market, same kind of property, you find a second opportunity and you could see the numbers ahead of you, but essentially that is a 10 times gross rent multiplier. By a show of hands, who thinks they know which is a better deal here? Chris, okay. I can't see anybody else think they know. All right, Shannon, okay. So I would say we don't have enough information personally. You have an inclination, but there's not enough information because all by itself, the gross rent multiplier isn't good or bad. It's just a baseline to compare. So this is how you can really, in a short period of time, learn a lot about a segment of the industry in your market. If you took, let's say, 10 cabins and went and saw their gross rents and their ask price and evaluated them, right away you would get an idea because you might see some 8s, you might see some 10s, you might see some 12s. Now, what does gross rent multiplier actually mean to you or an investor? It just means that the lower that number is, the closer to 1 it is, the faster the money comes back to the client because it's the gross rent multiplier. It means it's the selling price related to the income. Does that make sense?
Mm-hmm.
That concept is, it's important that you understand. So as the gross rent multiplier goes higher, that means that the investment return is less because the multiple that I'm paying is going to be more times. In that last example, 10 times is greater than 8.33. So you would, if everything was even and correct, it would take you much less time to get your money back in an 8.33 multiplier than a 10 multiplier. So the key here is understanding that it's a basic term to do to, so a basic filter to use for a client. To drill down further, the next tool we would consider, excuse me, before I go on, does anyone have a question about that? Because this is important that you understand this basic to go on further. April, I can't see you, but do you understand this?
Yes, I'm used to adding in the cost of what it costs to run the place divided by and the purchase price, but that's okay. I'm following.
Yeah, that doesn't in this formula for gross rent multiplier, you don't do that. You just putting in, there's only the factor of your year one, and that's the way you use this because you're looking at this tool only for acquisition. So you just put in the closing costs roughly, so
Mm-hmm.
I don't know what it is in your particular market. My biggest market was Chicago for years, so I would say it's about 6% of the value of the asset on top of the purchase price. So you'd add that in and then do that calculation through. Is everyone else square? And thank you, April, for participating. I didn't mean to put you on the spot, but
You pay
Okay.
cash here, it's usually 1 to 2%
it's 1 to 2%. Okay,
on a cash deal.
okay, on a cash deal. So, but with financing, you got to pay, you know,
3 to
lender
5 too.
fees and,
Yeah.
and that kind of junk fee. So whatever it happens to be in that market, maybe it's 4%, because I don't know how many cash buyers that you work with. I do know that there's a lot of cash buyers in your market, from what I'm told, which is great, especially in times like today, with banks being much more fickle. And we're going to talk about the difference between cash on cash with debt and cash on cash with equity as well further on. So if everyone understands that, I'm going to move forward. If anyone doesn't, please don't be embarrassed. There's no stupid questions. If you don't understand it, tell me, and I'll be more than happy to help you. All right. I didn't hear anything, so I'm going to move on. The 1% rule, again, is a filter, and all this is used to do is to help you go thumbs up or thumbs down on continuing to evaluate a property. So it really is a quick, you know, you don't need a calculator typically for this, right? So it's a 1% of the gross monthly rentals as a percentage of the purchase price. Now, I'm going to bring this back to cabins because that's the most consistent and the highest traded income property in your marketplace. So you would smooth out. So if someone says 75,000, divide that by 12. Don't try to do any one particular month, do a yearly average. And if that average is greater than or equal to 1%, you will want to go to the next step and take a look at that property. And just again, for an example, going back to that last example we had, the property that was bringing in $36,000 a year is $3,000 a month, which is equal to 1% of $300,000, right? So that would be like, I don't know that I'm jumping into that and putting in an offer, but I'm gonna go, oh, wait a second, that's getting close. Let's take a look at that. And why this becomes important to you all is because you're going to get a guy or a gal who's going to tell you, I'm coming to town. I want you to put me in a car and show me 100 properties. Well, I respect you because I've been doing what you've done 30 years, and I value your time, and I hope that you do as well. And what you want to do is be able to shortlist those 100 properties down to 10 properties that make sense. Because listen, at some point, if you drive somebody around to 100 properties and there's a bunch of dog crap in there, the guy's going to say, well, what are you doing wasting my time? And you're driving them in your car with your gas, right? So, but you're wasting his time. So this is a way that you pre-screen the assets to find kind of cherries, right? Now, sometimes you may find something that's like, wow, this thing is cranking in the money on paper, and then you take a look at it and you're like, wait a second, the numbers could be suspect, or you're like, no one is staying at this cabin and paying $350 a night. So like I said, it's a filter just to give you an idea to look further or to throw it in the trash heap. Because in the world of opportunities, last night I looked to try to find a couple of these deals on the MLS there. There was a huge number of opportunities. I don't know how you would filter them if you didn't have some kind of rule. These rules will do that. Everyone, if you get this, thumbs up. This is a pretty easy one, but if you got it, okay, cool.
And
Let me go to the
real quick, Mark,
Yep.
with the gross rent multiplier, you had the 8 there and then the 10. Is there a certain point where you would go, yes, that looks like a great indicator, or is it just for comparing the 8 to the 10?
So here's the deal. This is where your expertise comes into play, and it's a great question, by the way, Phil. Thank you for asking that, because this is a great distinction. You're the experts in your market. So if you take, and if you want to play along with me for next week, because we're going to do a little bit further, I would suggest, and I will offer some homework for you guys to take a look so that you could take these principles and just play with it. It's not like homework. I'm not going to grade you, but it's something that will make you smarter and make you more aware of what's a deal, because you're going to look at things differently. So let's say you go and pick 10 properties. Take 10 properties that sold in the last month and look at what it says on the MLS sheets, right? I'm old. When I started in the real estate, they didn't have the internet. They had a piece of paper. You go and sit with someone and go through it. That's how old I am. I mean, it's crazy. When I think of what you do today on your phone versus going and sitting in an office and someone going through a tear sheet and say, oh, you want to live in this neighborhood? Let me see the properties and flip pages. But look at the tear sheets. I don't know what they call them on your MLS, but the closed properties, and start to just make a little spreadsheet. This one, on Mountain View Road sold for 800,000. The gross income was 90,000. This one sold for this. This one sold for this. And then start to take a look, and you develop the baseline, and what you'll see is trends, right? And so there's a theory, it's called the tall poppy theory, right? So the person who sticks their head out the tallest, they get their head cut off. And it's not a great theory for equality, but it is for this, because you get to see that the ones that are outliers, the ones that are really high, you scratch your head and say, oh, that doesn't make sense. Or that guy or gal it was a fire sale. And the ones that are really low, then you're like, oh, somebody got a good deal. But between the highs and the lows, you'll develop your own gross rent multiplier. And the ones that are lower than the average off the bat, like it gets listed and it's lower than the average, jump on that and take a look at that for your client. And the ones that are higher, you're going to be a little bit slower to react to those. Okay, because the return to your client is higher. Now, there's an asterisk in all of this, and I know you guys will probably argue with me, and because I've been told that sometimes real estate brokers fib about the income. So I would say, I know probably not in Tennessee, but in other parts of the country, they lie about the income. But so I would say, take what they put on those income sheets and the things, take that with a grain of salt, but assume that everyone fibs a little bit and just use the numbers they give, because there's no way to know who lies at 5% and who lies at 10%. And that's why this is a gross rule. We're going to get to more specific stuff, but this is a way to sort and filter. Okay.
Awesome.
Sort and filter. That's the purpose. Yeah, no problem. Great question. All right. So cap rate. Now, I heard you all shake your head and say that you see or indicate that you know it now. April or Vernon, because I can't see you, I'm going to ask you directly. Do you guys understand cap rate and what it means?
The higher the cap rate, the cheaper the property, right?
That is correct. Yep. That is absolutely correct. And basically, to fully understand cap rate, think of it as this. It's the way cap stands for capitalization. It's the way the asset pays me as the investor back. A higher cap rate, like you said, Vernon, it pays me quicker. So it is less expensive. But less expensive isn't always great. And I'll give you a story about that in a minute. But the cap rate, especially over the last couple of years, because the cost of funds were so low, you saw cap rates go down quite a bit. That's called cap rate compression. That means that people were aggressively buying real estate as an investment at low returns, because the alternatives, a lot of people didn't want to be in the stock market, or the cost of funds was so low they wanted to do both. So the first thing you need to do to understand this a little bit more is to calculate the net operating income. And this is a pretty straightforward formula. I'm going to shift away from a cabin for a moment, because on more traditional commercial or investment deals, there's multiple streams of income. In a cabin, there's one stream of income. It's just the rental income. But let's say you have a strip mall and it's got 3 little bays and a car wash. So you're going to have the income from each one of those bays. You know, there's the hair salon guy, there's the insurance woman, and there is a retail offering, maybe a convenience store, 7-Eleven, and then the car wash. Each one of those people will pay rent, and that's a stream of income. You total all that up, and then you take any expenses affiliated with running that property, brokerage fee for leasing it, you know, water, electric, everything except for the cost of the financing. And the reason this is an important distinction is because if you're a new investor, you have a different cost of funds. But when Warren Buffett buys, let me tell you, his rates are a little bit different. And when hedge funds buy and/or insurance companies buy, they have different costs of funds. So this cap rate is based upon pure cash transactions. And why this is important to understand for you is because that makes everybody equal. Okay, this is the universal playing ground. No one can argue, well, that doesn't make sense. It always makes sense. If you analyze everything in an all cash world, the cap rate makes sense. And we'll adjust. Later on, I'm going to show you a formula to adjust for financing, because regular people like you and me and Phil, we need lenders. And most people on the planet need lenders. Let's be honest. Not everybody's a cash buyer. But if you get to learn a lot of these tools, you will be a cash buyer someday. Trust me when I tell you that. So let's give an example so you'll see and understand it. Again, going back to the total cost of purchase, right? All in for $800,000, and this property is earning $65,000 as a net operating income. So this cap rate would come down to an 8.125 cap rate. So I'm gonna ask Alyssa, do you understand what that 8.125 means? And I don't mean to call on you or pick on you, but I want, because I see you're interested, so I want to make sure you're getting this. Do you understand what that means?
Not fully.
Okay, cool. That's a great answer. So basically it means that an 8.125% cap rate is the rate at which my money gets returned to me. So in this equation, it's like
Okay, so I was
earning.
going back to the 10's bad, the 8 was better.
Yeah, this is a good distinction, and this is what trips people up, and that's why I did what I did. So it's okay, but when you see this, it'll make better sense. So yes, gross rent multiplier, higher is bad for, you know, because it means it takes longer for your investment money to come back to you. With cap rate, it means that the money comes back to me faster as the cap rate goes higher. So it's the opposite, correct? So in this example, basically, for every year you're getting 8. If you're a cash investor, you would get 8.125% of your cash back every year. If this was a perfect investment, if this was like a bond, right, and you bought it, you would be getting 8.125% back every year. And if you look further on down, so that means that in 12.3 years, if everything stayed the same, if the rents never went up, if nothing, the expenses didn't go up, taxes didn't go up, you get all your money back in 12.3 years. Now, over the last 10 years, if you bought something, you know, in 2013 at this 8.125 cap rate, chances are that you know it better than anybody. Everybody living there. Think about what you paid for rent if you were renting 10 or 12 years ago. And then today, they might be up 30%. So this cap rate, if you went to sell it today probably would be lower and you'd get more money, and your return, instead of it being 8.125, may be in the tens. Does that make sense? Because inflation pushes every year, typically, slowly over time. If you look, rents go up, up, and up. Yeah, there's years that they go down or stay stagnant. But if you look, I know my father bought his first house, I think it was 1954, and he paid $56,000 for it. Now, think about what you can buy for $56,000 today anywhere. You can buy some rural land maybe, but if you go to buy an improvement, you'd be lucky if you could buy a small trailer with real estate today. So over time, everything goes up. Now, to further explain this, well, first of all, do you understand the calculation?
How do you get, what's the 100? Where'd you get that at?
Okay, the 100 is 100%, right? If I want 100% of my money back, and I know the cap rate is the rate at which the money comes back to me. If I want all of my money back to me, I know 8.125 is my cap rate and what I'm getting on day one, but how long does it take? Because I just put 800,000, I took 800,000 after cash tax dollars into this investment. When am I getting it all back? I want to know. And you would say to me, about 12.3 years, Mark, plus or minus. Does that make sense?
Mm-hmm.
Cool. And great question, because I'm so familiar with this, it's second nature. So don't be, like I said, do not be embarrassed. Please ask. Any other questions? We're going to explain a little bit more here, but through example, but any more questions? April, we good?
Yep, we're good. I was gonna say though, I know for one investor I had in Florida, her cap rate is obviously like you said, the money they're making back, because it would be like if you put money in the bank, what is your interest that you're getting paid back? And that's why she was always around like 6 or 7% at the time. But
which is
that's
good.
how she, yeah.
April, honestly, this is an example, and historically, if you look at long-term returns from real estate, 6 to 7 is actually a really good number. And there is a term, and it escapes me, but if you want to get 100% return on your money in 7 years, just get an asset that pays you 7%. Because with compounding, you'll get all your money back. So, and that's a stock trader's, Bible kind of thing. So 7% is very good after everything. It really is. So we're gonna go down further with this and take a look at it. But just to make sure that you understand it, this is basically in this cap rate, because you're going with cash, your cash on cash return would be the cap rate explained as a percentage. Does that make sense? Because
That's
you're
8%.
Yeah, because you're 100% cash, right? Cash on cash return is what's my return relative to my equity. That's the exact same formula that we got here.
I've always heard that most investors want to make 10%. And that's
Yes.
the sweet spot, but I don't, that's hard to do, right?
Yeah, well, yes and no. It's tough to buy a property in today's market, that in a good market, that gets 10% back, but there are ways to enhance it. And this is bring up a good story. Back in 2005, I was looking at apartment deals for myself and my wife, and I looked at a small portfolio in Chicago and a small portfolio of apartments in Racine, Wisconsin. At the time, apartment buildings were trading at 6.5 cap in Chicago, which was pretty expensive. They were trading for about $200,000 a unit. It's kind of a rich number for a poor kid coming from 7 in an Italian family. I didn't have that kind of money. but I was able to cobble together some and buy a couple apartment buildings in Chicago, and I bought a couple of buildings also at the same time in Racine, Wisconsin. The cap rate there was 10%. I thought, look, 10%, I'm going to be making money hand over fist. This is great. Flash forward to 2011. My Chicago properties, in the middle of all that, we had the great, recession or whatever they called it when the market went into the toilet. And my stuff in Chicago held value. It went down probably 20%, but the income stayed. And by the time 2012, 2013, 5-6 years later went, I had enjoyed about a 50% increase in my equity in those properties. Whereas Racine, Wisconsin, I lost money. I made money along the way. I got paid rents, but my rents went way down, and I ended up selling those properties, for next to nothing to just get out because it was more of a management headache. So sometimes the cap rate, while it may sound more attractive, isn't always. That's why you use this in the same market, right? Because what I learned firsthand, even as somebody who held a lot of years of experience and nearly, I don't know, $700 million in transactions, here I thought I was so great. And I went out to buy, and I screwed up because I saw those big returns and thought, hey, I'll be able to manage it from afar, blah, blah, blah. And I was unable to do that. And I couldn't get around the economic situation that also happened. A lot of industry moved out of Racine, et cetera. But the point is that cap rate in itself isn't the only thing you want to look at. Again, it's a tool, and it will help you identify. Let's go back to cabins or just any kind of commercial. Again, if all the cap rates in your market are roughly 8-9%, again, your client tells you, show me some deals. Well, you go and evaluate a bunch of these. Are you going to show them ones that are cap rates at 5%, or are you going to show them the ones that are at 9.5 or 10%?
Yeah.
Okay.
Yeah, you're going to show him the ones that are at the higher rate because he's got a better chance of making it. But here's the thing, because you're the expert in the field. If I come, to Knoxville, from, Bumlick, Illinois, I want you to show me the good neighborhoods. Yeah, it may be a 10 cap, but is it in a bad neighborhood, or is it in an area that may never go up because there's a wastewater treatment plant there, or there's an industrial park behind it and the place always smells like something, whatever they're making over there? You know what I mean? Like those are factors. I'm not saying you can't get a return there, but to go back to cabins, if you're going to rent a cabin and it always smells like some weird smell in the air, your reviews are going to keep on coming up. And what maybe you hoodwinked some people and got them at $250 a night, but over time those numbers are going to go way down, and so is your cap rate. Or excuse me, and your cap rate will go up, and your value will go down. Sorry, go ahead.
Mark, I have a couple questions. So is there like a cap rate number that you would say you would probably not want to go below? Like what would kind of be like the minimum that you would say you would always want to be at? Would it be like 6%? And then the other question is, how do you calculate what the net operating, because you have to subtract the expenses to operate the investment. So how do you calculate that?
Okay, so those are two different questions, and let me answer them one at a time. And great questions, both of them. The first one was, is there a baseline, and if I'm wrong, tell me, is there a baseline cap rate that you look at or pass on? And the answer is the cap rate and what people buy on really depends on the investor. And let me further detail. So big insurance companies have all the money in the world, right? They're not applying for loans. They have the money. Every month we pay them money to insure us. They take that money. They have to They have to put it into assets that pay them so that they could pay claims, et cetera. They may be looking at assets that are very low in cap rate because they put debt on that, like 50, sometimes more % down, just so they get cash flow. So they'll look for premier assets just to get a consistent cash flow. But us as mere mortals, we want to get a return above and beyond what we could get in the bank. And remember when I said why treasury rates matter? I will touch on that more. So to answer your question, for me personally, I'm not really looking at anything in this market. I wouldn't touch anything that's a 6% or low because I am still relatively young at 57 and I want my money to grow at a little bit more aggressive rate. So I would look at a 6 cap deal if I thought there was a way to add value to it. So if it's an apartment building and all the apartments are trashed, I go, well, if I fix all those apartments up, can I take the rents up 25%? And then that would increase my return on my investment. Obviously, I'd have to take more money out of my pocket, but there's a way to calculate that as well. Not in this week's class, but if you come next week, I have a spreadsheet that I'll give to everyone that participates that calculates a lot of this stuff, and we'll one-on-one I could show you how to populate that and make sense out of it. But strictly speaking, cap rate and purchases for me, I would 6.5 would be about the bottom I would look at. And things up over 10 or 11, I'm starting to, remind myself of Section 8 hell up in Racine, Wisconsin. So that's my personal thing. But you could probably interview 15 different investors, and every one of them, guys like, hey, I love ghetto properties. Give me 10 of them. That's where I make my money. I learned, from having a portfolio of them in Chicago, as well as having them, in Racine, that's not my gig. I prefer not to do that. But there's a buyer for just about every property classification. So your job is in your market, what's a kind of the common cap rate. Again, like gross rent and multiplier, those same things you can kind of play around and infer. The question you asked about how do I know, the NOI? Well, unless you have sold one of these on your own, you probably couldn't figure out that precisely for every one of those assets. So for a single entity like that, I try to use, this is my personal calculation. Other people will do others, but for like a cabin, I say it's about 42 to 45% of gross. So if the cabin brings in $100,000 and I figure all in with advertising, management, that kind of thing, it's going to cost about 45% of the gross. That's my NOI. So 100,000, I'm going to say my NOI there is going to be 55 grand. And that's super conservative. But how you can, as an agent, learn about this is, Shannon, how long have you been an agent in the market?
Well, I've been an agent for 13 years, but I've only been in this market about 1.5 years. And so where I'm from, I didn't really deal with investors, so to speak. I mean, other than maybe, single family type, but as far as cabins and all that, I don't have any experience in that at all.
Okay. Well, so interestingly enough, you happen to work for a company that has some really, dynamic agents in the cabin market. What I would do is see if you can buy them lunch and sit them down and ask them if they would share a couple of their deals and their numbers with you. Maybe you can get, if you got a good enough relationship, they won't, but you'd be surprised with what people in your own company will share with you. I know I talked with people in different markets all the time, and a good real estate broker or agent will freely share information. You know, they'll be like, look, Shannon, I don't care what they tell you. If you do it right, you can get your expenses to about 40%. If they've done enough of them, they could tell you like that. And if they don't want to be bothered, or they're just so busy, they can say, yeah, I'll give you a couple deals with numbers and take a look at it, and you figure it out for yourself. Either one of those is a great, that way you're getting the information and you have a chance to look at it. And over time, you'll get a better feel. But you have to put in, you know, the miles. It's like building muscle, right? You just don't go to the gym once and go, well, I went to the gym yesterday, you know, my body's perfect. No, you
I think
have
Brian
you
did that.
what's that?
Brian did that one time.
Well, Brian, you're a lucky guy, man. It's taken me my whole life and it's still not perfect, nowhere near it. So, but you know, evaluating, you know, a few of these deals a week, over time, in a month, maybe you'll get a really good feel. And why this is also is important for you is it makes you sharper. So let's say one comes on and they're saying the cap rate is 10% and the gross rent multiplier is 6. You're like, well, that sounds too good to be true. Let's take a look at the numbers. Now, remember, you just looked at 4 deals a month for a month. So you looked at 16 deals and you kind of got a feel for what the expenses and the income look like. You saw some 2 bedrooms, you saw some 3 bedrooms, you saw a couple 4 bedrooms. So you could start to make some conclusions. You're like, you know, those pool cabins, they make a lot of money, but it costs a lot of money to heat those damn things, you know, or you know what, the electrical use is a lot. I never realized that. So now all of a sudden you look at this great offering and it's at a 10 cap with a 6 gross rent multiplier, and you look at those numbers and all of a sudden the expenses are 30%, and you're like, wait a second, how is that guy at 30 and everyone I looked at is 45? All of a sudden, now you get to learn about the broker puffing, because the broker's full of poo. He's giving you something that's not real. And you, because you took the time and invested in yourself and the knowledge, look that much better, because you don't show that to your investor and who's bought 20 of these things and goes, Shannon, what are you doing? This is garbage. And he throws it back at you, or she throws it back at you. Don't insult me. So you learn that by doing a couple of these over time. And if you have questions about looking at a couple, you know, you could reach out to me and I'll give you a couple minutes of my time. But if you get that data, and if any of you in this call get the data and you want to look at it for next week, get it to me beforehand so I could do a markup and we could go through one. In fact, for sure, we're going to do that. Whether or not you want to bring me one of your deals is a different story, but we'll do that next week where we'll go through it a little bit deeper. So now, is there any more cap rate? We're going to go on to talk about cash on cash returns after financing, but I want to make sure that we put this to bed and you understand, at least in a very broad sense, cap rate. Chris, do you got this?
Pretty much, yeah.
Well,
I need work, I need practice, but yeah.
But if you, is there something that's, you know, troubling you or you don't understand, ask. Like I said, there is no wrong questions, and this is how you learn. And so I'm here to support you, to help you be better at your job, not to, you know, poo-poo you. So please.
Yeah. So before we show an investor property, we need to figure out the expenses and all that.
You don't necessarily need to figure out the expenses, because you would spend so much time trying to get it. This kind of work you might want to do, you do want to do before you formulate a deal. So you, in this example, you took the guy who came from Cairo, Illinois, and he pulled up in a fancy car. He got a lot of money and says he wants to own a piece of the Smokies, because everyone wants to own a piece of the Smokies right now. And you show him 7 properties. Now he's like, I like 2. So how do I differentiate between one and the other? Well, the first step is you go to the broker and ask him or her, hey, give me the numbers. My guy is a real guy. He's going to write an offer, but he wants to see the numbers because he doesn't want to play the game. He's going to take it to his lender, etc. Can you give me some numbers? If they give you the humana, not right now, next week, through Tuesday, from next Thursday, forget about it. Unless he's a cash buyer and you know the market really well, and there will be a time where you will know the market really well. You just have to take the time to learn it. But in this instance, let's say you don't know the market really well, and you want to look out for your buyer, because if this buyer buys once and he does well, it's likely that he will tell, hey, I got this great broker, Chris, man, he's taking care of me. He found me a great place, blah, blah, blah. All of a sudden, he's going to bring 3 of his buddies along. And you want that. You want his 3 buddies. So you do the work at that point. But this is all information for you to know to take forward, and you can go and pull any deal and play with the numbers. I don't know your MLS well, because I only have access to the realtor.com MLS. I don't belong to any of the local associations. Even though I am a licensed Tennessee broker, I'm not a participant in the MLS there, but you could find it. And if you can't, then go onto LoopNet. You can get on for free and get a couple deals and just analyze. They won't be cabin deals, but you could analyze some small investment deals. I went on last night and found a couple in Knoxville. I found some strip centers that you can play around with, just so you can familiarize yourself and see how the numbers look. And I'm going to warn you, if you get a big strip center with a lot of moving parts, it's going to be complicated the first time. So I wouldn't go do that. I would do smaller things like 2 or 3, bays. And it doesn't have to be Knoxville. It could be any market that there's some investment property, and it could be multifamily residential. It could be like a 1 to 4 unit or bigger, but cut your teeth a little bit, and it may be worth taking a look at a 1 to 4 unit apartment building, or even a duplex in the same market you're in, because then you get a flavor for the numbers, right? So if a 2-bedroom apartment is paying, I'm making all these up, they're paying $100 a month in water, right? So, and they're living there, and they're doing laundry, and they're showering, their activities of daily life, and that's 2 units. Well, if you got a house in that market, you may not know what a cabin's water costs are. And maybe water's the wrong thing because you guys are on well up there, but whatever it is, electric, let's say. And if the landlord's paying the electric, you get to know, oh, he's paying $50 a unit for electric for a 1,000 square foot apartment. Well, all of a sudden, if this is a 2,500 square foot cabin without a swimming pool, you could kind of make some inferences. Well, it's $50 for a little apartment. It's probably going to be 100 or 120 for a cabin. Now, it's not perfect, but it gets you there. And you have to fill some of these spaces. You can't assume just because you don't know the number that there is no number, right? You don't know what landscaping is. It doesn't mean they don't pay for landscaping. Now, if a cabin's on a hill and there's no land to scape, it's different, right? If there's nothing but rocks and hillside, then you don't have to collect leaves. You don't have to do anything. Does that make sense? So there's some practice here, but I'm telling you, if you want to invest in yourself first, this is a good way to do it. It's investing your time. And over time, you will become an expert, and other men and women in your office will start to come to you and ask questions. And there's some investors in your office, I know firsthand, that own cabins that you could ask for, some information, and he would probably give them to you.
Got a question, if it's okay.
Yeah.
So how would you take a residential home and project what the short-term rental would be in that market? I've got a listing that just got yesterday. It's a 6-bedroom house, 3 baths, 3.5 baths, a log cabin. And we were trying to, get the projection for what the rental would be so we could maybe get her some, a good sale.
Sure,
Um,
based off that. Well, I was going to get to that at the end. I was leaving the commercial for the end. In the beginning, I don't know if you recall, but Phil was nice enough to say that I work with a company called Vacasa, and Vacasa is the largest property management company in actually North America, and we manage 42,000 homes across 5 countries. So how I would value that is I take all the data from my company and work with agents like you, and you would call me and say, hey, can you work up a pro forma? And for free, I would take a look at the house, and then I would take a look at all of my similarly detailed out houses and give you a projection. And you can give that to your client as the seller, and you can hand that out to the buyer and say, look, this is a publicly traded company. The guy who gave it to me has, provided me with training on finance, so I know he's not full of crap. He's given a real number, and he's been in the business for 30 years and owns 52 apartments. So he's not somebody who's never owned or managed property. He manages lots of properties all over the place and has for 3 decades. So not everybody at Vacasa has my background, but fortunate for you, you actually have a guy who will do right by you and your clients. And I won't tell your client that it's going to bring in, and sometimes this makes them mad, that it's going to bring in $180,000 when the market says it's going to bring 120. Because at the end of the day, if I lie and you lie and the buyer buys this and they go bankrupt, this is not good for anybody, and this, there has been so much aggressive buying in this particular market. I think now you see a lot of cabins come out and they're trying to say they're going to make $200,000 a year. And I'm telling you, we have, I want to say, almost 600 cabins in the Gatlinburg market. And I can count on one hand how many make $200,000. So, and it only take 2 hands and 2 feet to get the balance between 150 and 200. So you're more like, that I can give you realistic projections. I don't know that everyone does that, but that's how I would do it. If you had to value it yourself without the aid of Vacasa and me, how you would do that would be by comparison. You would have to go and look in the marketplace and see what these other people who have sold 6-bedroom homes claim that they're earning. And then what I would also do to benefit my clients would go and talk to some of those brokers, and hey, Shannon, you just sold that great cabin up on Mountain View, 6 bedrooms, 5 baths, pool cabin. Wow, that thing was a monster. Look, it's closed now, but can you share with me those numbers? Would you be open for it? I'm not going to send them out to anybody. I'm trying to evaluate a similar property, and I would like to get an idea of what the numbers look like. Would you be open to do that? Some people share, some people tell you to go pound salt, but I think the more agents who are doing bigger deals that you talk to him or her, they'll share. There's always going to be somebody that won't share, but in your best interest, I always share when people ask. And in the long run, look, there's more than enough money for all of us to be wealthy. So what are you not sharing with me for? You're stingy with somebody else's information? And if that's that what happens, move on to the next. I don't mean to preach, but I mean that's just life in real estate brokerage. And my business that I sold back in 2012, I had offices in 3 different states and did national business. So it's not that people are stingy everywhere or anywhere. They're just the kind of person that's everywhere. You know, sometimes they're just so busy they don't have the time. They won't do it. But you know, most people will say, I'll get you the information. They may not want to talk about it, but they'll shoot you a spreadsheet.
That'll work.
So I'm going to move past this because I don't want to, I started late and I know I'm probably past my time. But this is the crux of why, and I think you all have asked, why cap rates are important. So if you determined in your market that an 8 cap is about right, Shannon, remember you were saying, what are you going to look for? You would take a screenshot of the market and go, 8 cap's the right thing. Now someone brings on a new cabin and it's a 5 cap, and your client says, hey, I want a deal. Are you going to show them the 5 cap? You're going to show them the ones that come out that are 8 or a 9 cap. The cap rate is a baseline for you to be able to understand whether or not it's worth to pursue. Now, back to your question earlier, Shannon, well, how do I know? Like, how do I know the expenses? Well, once you determine a formula that works, and I'm going to say 45% as a conservative expense ratio, and it could be less. If they self-manage, it could be, you know, significantly less, right? So, but it's very highly likely that if they're self-managing, their income isn't as great either, because normally property managers do a really great job at filling a place up where people that own a cabin don't have the technological expertise or ability to market with 6 or 7 different websites to find buyers and renters all over the place. So that being said, once you determine an expense ratio, you can review a bunch of these. And the truth be told is you could just use 40 and never get anyone's opinion until you 40 as an expense ratio, right? So every deal that comes up, if you just use 40 across the board, you've created your own filter or cap rate determiner. Does that make sense? So all you're looking at is gross rents on 100 cabins, let's say. You look at 100 cabins and they go from 50,000 up to 200,000. And you put that same 40% expense ratio, you come up with an NOI. And then you back that into the ask price, boom, you've got cap rates. Now you've got a various number of cap rates across 2-bedroom, 3-bedroom, 4-bedroom, 5-bedroom in this example. And why this also becomes important is if you want to price a property, right? So now you get a listing and I come to you and I say, I got a 4-bedroom cabin and it makes me $120,000. Here is my tax returns. You're like, great. I have real numbers. I have real income. I can determine a true cap rate. And you look at the marketplace. But the guy says to you, I'm the guy here and I'm greedy. I like money, right? Who doesn't? He says, I want to sell it at a 6 cap. What are you going to say as a real estate broker? That's a question, Shannon.
It's not gonna sell quickly, right?
Or you inform him, look, Mark, I know you like to sell at a 6 cap, but in this market, these properties are selling at an 8 cap. So I could put it on the market at a 6 cap, but know that it's more likely to sell closer to 8. Are you flexible, or are you just going to hold at 6? Because I don't know that I could find you that buyer. I will do my best, and I know this sounds like a dicey conversation, but as you get better in your business, these are the conversations that mean money, right? Call a guy, in this case, me, the greedy guy, You don't call them greedy because that wouldn't be good, but you educate them to what the market looks like, and then ask them if they're open. And if the guy says, listen, I don't give a crap, I'm not going to take anything under $1.2 million, and you look at it and you're seeing what trading at $1.2 million looks like, and all those cabins, like when you look at them, you hear, the sounds of hallelujah behind it. And you look at mine and it's like, you hear dumpsters, don't take the listing, because you're going to spend the rest of your times as a preacher praying that the guy's going to lower the price so you can sell it. Stick with your guns. Tell them that it's never going to sell for $1.2 million. Tell them you'll see him when his listing expires with the guy who takes it, and you'll be back with $1 million offer or a $950,000 offer in 6 months. But you can't promise him that, because the market could change and it goes away from him. Because if our great Fed makes 2 more stupid raises in the interest rates are going to be at 8.5, 9. And that impacts the value of his property. So this is the kind of thing that once you're loaded with this understanding of the finance and cap rates and interest rates, you're so much more powerful in your conversations with the sellers. And conversely with the buyers, guys like, well, I'm only going to pay 500,000. The guy's got it on the market for $1.2 million. It's like, come on, get out of my car, leave him on the side of the road. Value yourself. And how you do that is investing in yourself and getting to know this stuff. So this is, a way for you to be smart, because it's math, right? Like when we go back to this thing, if someone says, hey, I want to buy a property on a 10 cap, and this property all in was 800,000, right? Well, this guy could buy this property conceivably on a 10 cap, but what's he going to pay for it? It's easy. A 10 cap is like a math equation. So you put 65,000 over X equals 10, 650,000, right? I was going to buy it at an 8.125 cap, but let's say I don't buy it. Your buyer wants to buy it at a 10 cap. The ask price is the 800,000. If the client sells it to me for 650, I got my 10 cap. Does that make sense? Like you could price properties this way too. The cap rate is a really powerful tool to understand. We're going to get into this more next week. I don't want to burn up so much. Let's go one step further with this cap rate discussion, because as I mentioned earlier, we, just the regular people who aren't Warren Buffett or trustafarians being people on trust funds or the children thereof, we need banks, right? So we have to figure out how that comes into play. So I'm going to do that, and then we're almost done here. Let's assume that same thing, $800,000 purchase price. It's a conventional deal, and we're going to say that this is an apartment building so we can get 30-year financing. We put 20% down at 6.5%. Our payment is going to be $48,000 a year. So to figure out our net income after financing, we take the NOI, which we know is 65. We minus out the financing costs, which is 48,543. And we come up with a net income of 16,457. Really important. Is everyone with me right now?
Yes.
Yes.
And Chris, you don't have to worry. I'll shoot you this slide.
Okay.
So you don't have to take pictures. You can have all this. This is all for you. Don't worry about it. No, it's all for all of you. I'll give it to Phil. I mean, you could thank my wife who is great with Canva and put this together. Hey, Brian, are you with me? You're muted.
I'm with you.
Okay, so this is a key distinction, guys. And why this is a key distinction is because you and me are regular people. And what does $16,457 represent? Who knows?
It's
Cash flow.
it's your net income. It's it's cash flow.
It's cash flow. It's what fits in your pocket or your pocketbook. This is the money. This is what we bought this property for. So how do we determine if this is a good deal? Let's roll tape forward, okay? We know 16,457 is what we're going to put in our pocket. And the NOI, remember, that's all the cost all in, except for financing. But now we've got the financing in, and we have a debt that we know is fixed. So we want to do our cash on cash return. So we take that net income after financing, what we just figured, and divide it into the 160,000, which is our total down payment for the property. And you could lump in closing costs if you want to, but for the sake of this, I just put the down payment. So in this deal, your year one cash on cash, and I'll explain that a little bit more about why I said year one. Your year one cash on cash is 10.3%. Now, I think, April, it was you who said your client in Florida used to buy at 6 and 7%, right?
Yes.
So in this fictitious example, do you think that she would be interested at 10.3%?
Definitely.
Right. Now, here's the kicker, guys. If everything I said didn't entice you, I'm going to share another story with you. Why this is important to understand is because there's always times in the market where there is pricing discrepancies. And there is sometimes opportunities that come to you where you can buy assets and you're able to take a look at this. And maybe you get a broker who doesn't know what he's doing or she's doing, and they're in violations of the Realtor Code of Ethics because they don't have any clue. But they put a property on the market that should sell for 350 or 400,000, and they put it on for 250. But because you've been doing your homework, you all of a sudden go, holy crap, this is a great deal. You have confidence in that deal. You buy that deal, right? And now flash forward 15 years later, you could live off the income of that deal.
Get the
Now,
best ones.
now you say, oh, that's not true. I'm telling you it is true because I did that. I bought an asset in 1999 and I lived in Malaysia from 2013 to 2021 off the cash flow of that one apartment building. And I'm not special. I just knew my math. And I'm not even that great. The guy who mentored me in this business, he's got 5,000 apartments and he just plopped down $13 million on a house in, I think, Virgin Gorda, like 65 acres of oceanfront property that rents for $25,000 a night. So, you know, and he's the same age as me. So
What's his number?
you can look him up. His name's Bill O'Kane. He's a real guy out of Chicago. Google him. He's a solid guy, man. But I'm telling you this because as you take the time to explore this, it makes your tools sharper, and you could jump on opportunities for your clients and sometimes for yourself. And what I did when I was young in the business is I didn't have any money, but I had a lot of ambition. So I found 2 or 3 of my buddies and we started buying properties together. And that's a way that you can do it and feel confidence. And you don't have to buy multifamily income. I lived in a big city. It made sense. Here in your market, it may be buying duplexes or cabins, or maybe some other asset class. I don't know. You figure it out. It's your market. But understanding these basics can change your life. And I don't mean it like in some like religious way. And I do believe in God, but that's not what I'm talking about. I'm talking about change your life financially. Because
Yeah,
when
we
you
were-
go,
We
when
were
you go,
talking about doing that, but going together as a office and doing that. So
Yeah, well, years ago, my office tried to do that, and it was kind of complicated to get a bunch of participants. We ultimately did it with a couple guys, and one girl and three guys in my office. So it's very possible, but it all starts with the basics, and this is the basics. And then my last slide here is to talk a little bit about Treasury bill rates and why they matter. So right now, if you looked, the 6 month, 1 month, 2 month, and 5 years, I thought I populated these. Apparently I didn't. The 6 month yesterday was 4.65. The 1 year was 4.63. 2 year, I don't remember, it was 4.10 or something. And the 5 year is 3.6. Why do you give anything about that? Is because the wealthiest people in the world have cash, and if they're going to invest, if they can get 4% sitting in the bank with no risk of tenants paying taxes going up, insurance, fires, all that crap, and you show them a deal that's 4%, you're not going to get them off the couch. They got to get a yield over that 4%. Shannon, you asked me how I price properties. I figure I have to make at least 3 full points over what long-term money is to be interested. So in this case, five years, you're looking at 3.6%. I got to really be closer to 7% return on my investment to be interested. That's me. Somebody with a lot more money and pulled it out of the stock market may go lower, because I don't know if you guys have taken a look, but the Dow Jones lost 9% last year, and that stinks. But the S&P lost 18%, and that stinks. But NASDAQ lost 32.4%. So the men and women with money are looking at real estate as an asset class. So now is a time to understand this aspect of financing more so than before. Those sharp men and women that are well-heeled with a lot of money are looking for good real estate brokers that are honest, that are going to bring them good deals. I feel like I'm talking to some of them, but you got to do the work. That's it. Any questions? I'm happy to take them, but understanding these basics can and will change your financial life.
I don't have a question, but I do want to tell you, I lived in Racine, Wisconsin. That's pretty cool.
Oh, really? You did? Yeah, I had an apartment complex on Douglas Avenue there. I had an apartment complex in Jicado, and I'm failing to think of my third one that I had there. That was another big one. But the market there changed dramatically because of all of the industry moving out.
Yeah, I've got a friend. Well, my dad and mom have a friend that has 40 something Airbnbs in Racine, and I cannot talk him into buying in Gatlinburg. I mean,
well,
I don't know. I don't understand it. I'm not the best at it, and he was just, I'm not interested. Okay.
Well, there's a lot of reasons for that. People feel comfortable managing their own property. They know that market. You know what though? Keep
He lives in
studying.
Phoenix.
Yeah,
He lives in Phoenix and has all
but he
this.
likes Racine. Well, keep studying, because the more you know, you're not confident enough.
Yeah.
No disrespect to you, Chris,
That's true.
but he's going to put hundreds of thousands of dollars into an asset. He wants you to tell him why.
Yeah.
He didn't say no to you. He said, not yet. Get your numbers down. Show him why an asset looks better than all the other assets, or is just a solid returner. Look, this cabin is ugly in all the right places. From the outside, it looks good, but in the inside, it is ugly. Someone blessed it with the ugly stick. You go in there and do the numbers. Hey, if we put in a new kitchen, if we change this room around, we do this, it's going to cost us $75,000. But these cabins turned around could make X. And no one else is looking at it because it's ugly. And the other thing to do is what I used to like to do is take a look at all the properties that have been on the market the longest and review those once a month. Just take the bottom tier and look at all the ugly ducklings and follow them. So you look at something that's been on the market for 6 months, it went from 700 to 600 to 550 to 500. I was an auctioneer. Do I hear 4? Now 3.5, now 3, right? As we're going down, it starts to look better and better. You don't always have to buy trophies. Buy the dogs, fix the dogs, put the money in your pocket. Don't have the money, be a better salesman. You'll find the people with the money. You'll find the guys with the hammer or the girls with the hammer. Don't mean to be sexist, but you'll find them. I had a database. I still got a database. I haven't been practicing my real estate in Chicago in years, in over a decade. But I still got all those guys, and I could call them at any time, and I do call them. So, this is a business, and it's a great business, and you guys are in a unique place because you're not reliant only upon the people that live in this market, because you got 12.5 million people a year that come there. So that's it. The real estate reverend has completed his sermon. If you got any other questions, you could reach out to me. Again, my company is Vacasa. It's a great company. I'd be happy to help you with pro formas on any of your properties. I will get this link out to, or this out to you through Phil. And anything else? Otherwise, we'll get off the call. Phil, I'm sorry, I don't even know if he's on there. I haven't seen him.
No.
He texted me and said that he dropped off. He
Okay.
he lost service or
He
something.
lost service. All right. Well, he's out with the dog. Well, I hope that you found this helpful.
Mhm.
That was great. Thank you.
Thank you
No
very
problem.
much.
Yes,
Listen,
thank you.
Thank you.
I put my phone number at the bottom of this, but I'll share with you my email. And if you have a specific property, and if you want to come for next week's class, send me one of your properties that you're kind of looking at, working at, and I can do those numbers on the class. So it's real numbers. Whoever brings me the best looking, and when I say best looking, it means a property that has complete numbers, because I want to show you how to use those numbers. You can use my formula, which is saying 40%, but that's not the best way to do it. And at the end of the day, the way a bank will underwrite this thing is by looking at those numbers. And we'll talk about that, because we just scratched the surface. Those 4 letters in the back of my name, certified commercial investment member, means that I had to do a lot of spreadsheets, and I'll help you figure it out. Okay. And my email is mark, M-A-R-K, dot R-A-C-C-U-I-A at vacasa.com, VACASA.com. Okay. Well, thank you. I really
Thanks,
appreciate
Mark.
your time and
Yes, thank you.
attention. Yeah, no, I appreciate it. Vernon and April, I hope you got something from it. Brian, I see you
Definitely.
smiling. I hope you got something from it. Chris,
Yeah.
I know you're going to show me some stuff, man. I have confidence. I see the hunger. The dollar signs are lit up in your eyes.
Yeah, that's my motivation right there. You got me.
You know what? I don't care what people say about this country. Money is still a good thing,
Yeah.
so go get yourself some, learn some skills. These are really great basic skills to have. And I'm telling you, just understanding these skills will put you ahead of almost everybody. You wouldn't believe the people that don't get this basic stuff. And
Hey,
when you
Mark.
come up, yep.
Hey, it's Vernon here. I've been driving a lot for that. I've been listening the whole time. I've gotten a lot from this. I appreciate it.
That's cool. Thanks you, man. And I
Thanks.
hope that that you use some of this stuff, because it will
Yeah.
make a difference in your
Absolutely.
income. So, all right. Thank you, everybody. I appreciate
Yeah.
you, and I appreciate your time.
Thank
Thank
you,
you.
Mark.
Have a great day.
Thank you. Take
Bye.
care. Bye-bye.
See you guys at the office. See you, Brian. Good luck today.
You too.
Let's make some calls, buddy. Hey, we're gonna get together